Welcome back on to Market Conversations. Then Prateek Parekh from Nuvama Group is joining us now to discuss his top ideas. Prateek, good morning. Thank you for joining in. You know, it's been a whole host of bad news across the globe, be it on the tariff front, be it on the geopolitical front. The markets are in the world of their own. They're neither here, they're neither there. They're still not going higher, but not falling either. They're still respecting those levels. What are they pricing in, to be very honest? Of course, this geopolitical tension will not last forever. Sooner or later, it will be resolved. Is there a hope that the Q1 earnings season that starts in just a couple of weeks from now will be a lot better than what FY25 was? And is that what the market is currently pricing in?
Yeah. Yeah, thanks so much for having me on the show. It's always a pleasure to be on the show. I think if you look at markets, generally three things that drive markets. One is cheap valuations. Sometimes, that itself becomes a trigger. Second is liquidity, and third is earnings growth. I think among the three variables, what is keeping market afloat despite all the global uncertainty is liquidity. Liquidity has meaningfully improved from where we were, 6, 12 months back. RBI's LAF surplus is now more than 1% of an ETL, which is very significant improvement. And that is one of the main drivers which has calmed the market and stabilized the same. I think when it comes to earnings, there the visibility is still missing because in F25, earnings growth has reconciled with top line growth, which is in single digits. And the gap between earnings and top line is likely to be minimal going ahead as well. And on the top line front, unfortunately, the outlook is not very great because you're having a scenario where exports and credit growth both are weakening. And in such a scenario, it's very difficult for top line to see meaningful acceleration. So I think we are having a scenario where liquidity easing protects your downside, but high valuations and kind of moderating earnings, cap the upside. So perhaps we're probably poised for range bound for some more time, is what I would say.
Okay, so range bound, and this is the range we'll keep expecting, because today I was just talking to Urmaz as well, and I'm like, why is it not falling? Why is it just being resilient? But liquidity is a factor that you're mentioning that, is keeping the markets at least falling further down. But earnings growth and valuation missing on that front is something that is capping it on the top side. But valuation's expensive. So is there any pocket that you find some bit of a respite at least coming in? You have that monsoon data that's coming in as well. I expected that July, August would be better. This is what we spoke to SkyMed today. So could we see consumption as a theme start improving, or agri as a theme? What are you watching out for right now?
Yeah. So again, thanks for the question. So I think, see, on monsoon, people play, I think, overemphasis to it. Monsoon comes every year. I mean, 3 out of 4 years is likely to be good. Monsoon was good last year as well, but I think consumption barely picked up. The main stumbling block for consumption is, the overall income dynamics, where, corporates are pruning costs, curtailing capex, government is focused on fiscal consolidation, and export outlook is weak. This is a combination which is not giving sufficient incomes to households to go and aggressively spend. The main constraint is incomes and also credit slowdown that happened last year. So I think if monsoon improves, can some portion of agri get a relief? Probably. But is it going to be a very big needle mover? I highly doubt it. I think with regards to valuations, that is where, finding the next space is becoming a little challenging. Today, the pocket of valuation are entirely on the financial space, which is, private banks, which despite the rally are still reasonably valued, and also some of the NBFCs. But barring that, to find value comfort in either consumption space or the industrial space, I think that is missing. So that's where I feel that while financials have value, the growth outlook is weakening, although liquidity easing should help. But clear-cut sector space, where we can see a big demand spot coming through, that is somewhat missing right now.
So where are those sectors where there is a clear demand spurt visible? Is there a sector like that, be it the industrials in terms of their order books, or the power sector companies, or be it the defense or the railways? Is there any such pocket that you are currently betting on, Prateek?
Yeah, so I think our approach to portfolio construction has become more of what you call bottoms up, and our main point or our portfolio construction is that on the demand side, at least from a next 6 to 12 month perspective, it's not things are clouded everywhere. Although from a 3 5 year perspective, we are still optimistic on demand revival coming through, consumption and capex improving. But from a next 6 to 12 month perspective, there is little differentiate from a particular demand center. Where I think the portfolio construction or the earnings swings or the alpha will come is essentially on the margins part. We have a set of companies that margins are at the bottom cycle. For example, chemicals, metals, cement, some of the QSR names. And there are a set of companies where margins are at the peak. Essentially, in a scenario where demand is weakening everywhere, those at the peak margins will probably find it difficult to even maintain operating leverage and sustain them. And those at the bottom margins, there I think the earnings disappointment risk could potentially be lower because companies can cut cost and ensure that the operating deleverage risk is reduced. So I think from a next 6 to 12 month perspective, from a portfolio construction, margins swings will be a more important driver of alpha than necessarily the top line swings per se on Mars.
Uh, Prateek, what about IT, right? It had seen that fall coming in last year. Now, seems like it's picking up pace. So don't you think that this is where maybe we could see value or enter into this one? Like Sterlite Tech recently got that order as well, and we have seen it run up 50% as well. So, what's your thought on IT?
Yeah. Yeah. So I think, see, these days market cycles have become very short. I mean, post-COVID itself, cycles have been short, but now of late, the cycles have become even shorter. So I think on IT, our view is on a marginal underweight side, and the rationale for that is that there is global uncertainty. Valuations today are above, are meaningfully above their long-term averages, while growth is already below long-term averages, and the outlook as well on the growth part isn't very promising. So from that perspective, if I look at purely from a valuation and growth angle, IT isn't very exciting per se. Also in this sector, while margins are at the lower end, what we have seen in the past is that margins have been moving or sliding lower only. So the scope for margin expansion also is somewhat limited. And that's why, from an overall sector perspective, within the sector, there can be a few bottoms up ideas. But from an overall sector perspective, IT is not still looking very promising, is what I would argue.
Right. Prateek, there has been a lot of debate about the auto sector currently. Now, there has been a deal that has been signed between the US and the UK, but that will, of course, limit the tariffs to 10% from UK exports, and which is okay for a company like Jaguar Land Rover, which exported exactly 1 lakh cars in 2024 to the US. But in the sector as a whole in this country is facing a bit of is a double whammy of sorts, right? There is domestic demand that is lacking. You already have exports that are struggling, if not okay or stable. And now there is a conversation that the excise or the GST on luxury cars could be hiked further. Now, what does that do to a sector like auto, which is already struggling? That adds to more trouble. Do you see this becoming possibly a structural issue for the sector as a whole, or only select pockets could be hit because of this?
Yeah. Again, good question, Hamas. See, I think clearly from an auto sector perspective, as you rightly mentioned, it is undergoing challenges. Challenges are because the incomes are weak, so only within auto as well, the growth has been very very skewed towards the premium end. The growth hasn't been broad-based in the first place itself, and even on the premium end, if we are going to get regulatory actions, then obviously it is a sign of hurry. So I think from an auto sector as well, I think the challenges are what we have in other sectors where demand is moderating. There are concerns coming up both on the regulation part, but more importantly on the margins part, given the supply potential, some rise in steel prices, and also some of the supply disruptions that can potentially come out from the rare earth supply in China. So this is a sector that is going to go challenge. Now, is it going to be structural? I don't think so. We have seen the sector go through many cycles and many challenges, and it has bounced back. The penetration levels, especially of PVs in India, are still quite low, and that certainly means that they do have a long runway. But yes, in the near term, this is a sector where again things could get challenging, especially given the fact that their margins are also at the peak, which
Sure.
obviously can lead to operating deleverage as well.
Okay, Prateek, thank you so much for joining in with us on the show, as well as talking to us about the markets and which are the sectors that you're looking out for. But on that note, slip into a break, and after the